Wells Fargo, once the largest loan originator in the United States, announced some big news in the world of real estate. They are changing their business in order to protect themselves against the risk of mortgages and from what appears to be potential trouble on the horizon for home mortgage companies and anyone really dependent on home sales as a major source of their income. This announcement comes after Wells Fargo literally laid off thousands of employees in their home mortgage division in 2022. So what does this tell us about the housing market outlook? As Wells Fargo is not the only one scrambling to survive in this major housing market downturn. Welcome back and thanks for watching this housing market update. If you're a first-time viewer on our channel, we welcome you, and if you like the video, go ahead and subscribe. This will keep you informed on everything real estate. So Wells Fargo, one of America's largest players in home mortgages, has been announcing cutbacks in their mortgage division since the real estate bubble burst in April of 2022. Their mortgage division, Wells Fargo Mortgage Incorporated, headquartered in Des Moines, Iowa, had 10 rounds of layoffs as of September of 2022. And back in October, the Des Moines Register had reported that Wells Fargo's chief financial officer, Mike Santomassimo, told analysts that we expect it to remain challenging in the near term, and it's possible that we have a further decline in mortgage banking revenue in the fourth quarter. And as of the article that was posted on October 14th, Wells Fargo had laid off about 400 employees in their mortgage division. And Reuters.com had reported recently that Wells Fargo had laid off thousands of employees in their mortgage unit across the country in 22. Now, many people that are depending on home sales for their income are wondering just how long will this housing downturn last? When we see companies like Wells Fargo or many other major industry leaders in the housing market announce company layoffs, based on these big companies having so much data, I think it's fair to say that the downturn may not be as short-lived as many would hope. Now, in this recent announcement, Wells Fargo has decided to exit correspondent lending and reduce its mortgage servicing portfolio, all in an effort to slim down its mortgage business. They also wish to narrow their focus and invest another $100 million to advance racial equity and home ownership. They also indicated that they would still continue to provide home mortgages for their customers, and they will continue to specialize in providing mortgages to minorities as their commitment to provide equal housing opportunities for everyone. So now you may be asking, what is correspondent lending? It's when a lender originates and funds a mortgage. And in many cases, this is mortgages that are presented to these lenders through mortgage brokers. Once the mortgage is finalized, the correspondent lenders then sell the mortgage to entities like Fannie Mae, Freddie Mac, pension funds, insurance companies, and government entities like FHA and VA. This type of loan sale is often referred to as selling the loan to the secondary market. These entities that purchase the mortgages then package these loans and sell them to other investors as mortgage-backed securities. The correspondent lender in this scenario funds the loan, sells the loan to the secondary market, and then in many cases, they continue to service the loan, which means that they collect your mortgage payment as well as continue to maintain your escrow account, making sure that your insurance and your property taxes are paid for the investors that ultimately purchased your loan. So I were to think if Wells Fargo is reducing the amount of loans that they're servicing, collecting payments, making sure bills are being paid, taxes and insurance for the borrowers, by reducing this department, I would imagine that they will lay off even more people as this plays out. And by the way, this is information that is based on my own research. I am in no way a mortgage expert. I am a real estate broker, but I do work with these mortgage experts as my business requires. So why is Wells Fargo taking such drastic measures to reduce their mortgage division? As I can imagine, they have made a lot of money over the last several of years because, like many other companies depending on housing market sales, they're probably getting crushed with expenses from employees that they no longer need, as we're seeing the second largest downturn in the housing market since World War II. Forbes.com reported in an article that they published on January 7th, pending home sales have declined for 6 straight months. An article on January 5th, Redfin announced pending sales dropped to the lowest level since at least 2015. And at the end of December, The Real Deal published an article stating that November's home sales decline was the largest in 10 years. They stated that home sales dropped 35% as the market reversal continues. Now, these articles are referring to the largest downturn in housing since World War II, the 2008 housing market crash, also known as the Great Recession. And now, as we prepare to roll into what should be the best time for home buyers and sellers, spring in a normal market, the question is, will we see home inventories increase like it typically does in March and April? Or will we see the stall in home sales continue as the higher mortgage rates and still high home prices continue to cause a major divide between what home buyers can afford and what home sellers are willing to take for their overpriced home? A big determining factor, I believe, is whether the Fed will pivot from their promise to continue to raise interest rates in 2023. And will the Fed Chairman Jay Powell give us some type of indication as to whether they'll pivot in their January 31st FOMC meeting? The FOMC that's responsible for setting the interest rates meets 8 times a year. And as we now know, in 2022, the Fed raised interest rates 7 out of their 8 meetings, representing the fastest interest rate hikes ever. This rapid rate hike may have single-handedly crashed the real estate market by finally bursting the housing bubble. Home buyers that purchased at the peak or close to the peak in April of 2022 will probably be underwater for quite some time. Meaning if they need to sell anytime soon, they may be forced to take a loss compared to what they paid for their home. Now, for those of you who think that we may see 4% or less mortgage rates again, you may want to consider this. Back in 1934, the Federal Housing Administration was created to extend mortgage terms to 20 years. Prior to 1934, the typical home mortgage was about 5 or 6 years in length. It was an interest-only loan that ballooned at the end of the term. And here's one for you. Home buyers had to put down at least 50% to purchase a home. And by the way, back in 1934, mortgage rates were 5.5%. And ever since, I think over the last 40 to 50 years, the 30-year mortgage rate hovered somewhere around 7.7%. This is nothing close to the cheap 2.75% 30-year mortgage rate that we saw just about a year ago. And for the last decade, we've averaged 4% or less. This cheap money has probably helped to create the housing crisis we've experienced. Cheap interest rates help people buy more home than they probably should buy, and cheap money has also enabled investors to leverage their ability to buy more houses than they would otherwise. This helped to create so much competition between real estate investors and owner-occupied homebuyers. This bidding process jacked home prices up more than we've ever seen before. Wall Street-backed companies and foreign investors were able to raise plenty of cash to buy as many single-family houses as they could find. And in some markets in the United States, it's been reported that institutional investors purchased more than a third of our single-family houses that could have otherwise gone to owner-occupied homeowners. So thanks for watching this video, guys. Time will only tell what happens to the housing market. I believe that this is just the tip of the iceberg, as I've never seen anything like this before in my entire career of more than 30 years serving the housing industry in one way or another. What comes up must go down, and as we know, history has told us that the real estate cycle comes in full circle every 18 to 20 years. Would love to know your thoughts and comments. You can drop them below. And if you like this video, you can let me know you did by hitting that thumbs up. And as I mentioned before, if you haven't already done so, subscribe to our channel, hit the alert bell. This way you will know every time we upload real estate content just like this. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.